I want to do my modeling. My modeling means that I want to do some projections into the future. That okay, let me project that if I go into this business, how much can I make in few years time? Let's say in 5 years time. All right. All those money I will make in 5 years time, I will estimate them, and based on based on some assumptions, and then I will, because they are future values, they are future figures, I need to bring them to present values. So for me to do that, I will need a discounting factor. A discounting factor. That means if the in this case, the discounting factor we use for NPV is what we call cost of capital. So the cost of capital here has average name. The average name is called WACC, which is weighted average cost of capital. Please, like I said, WACC, with average cost of capital, of course, talks about the average of all the capital we have employed to, to fund our business. So on that note, we say to get the WACC, of course, there's a formula we use for WACC, which is WACC is calculated as cost of equity times the value of equity over value of equity plus value of debt plus cost of debt times value of debt 1 minus t over the cost of debt. Now, this particular WACC formula is just for two capital, which is basically equity and debt. Like as I was saying, I said this WACC, we use it to bring down the future value into present. The future value into present. That is this WACC, or we call it cost of capital. So how do we get this discounting factor? Because if you are dealing with NPV, by the time you say initial outlay and then the cash flows, the next thing is you bring discounting factor, maybe it's 10% or 5%, you find it 1 plus R, then you discount it, find the present value, and then you calculate your NPV. That discounting factor, how do we arrive at it? That is what we want to look at as cost of capital. Are you there? That is what we want to look at as cost of capital. Okay, so having said that, then we say for instance, if we explore just two capital, how do we know the capital we employ for a company? That's it. Very good. Now we will examine their equity and their long-term liabilities. We don't have any business with their short-term liabilities because that one they do not use it to fund their business. Although they may say, okay, they may have overdraft as a short term, or maybe they also buy some goods on credit. We cannot use that one to evaluate projects. The reason being that those ones are short term, unless the overdraft is interest bearing, right? So we can't use supplier or payables as short term. As capital employed. Why? They are just for 1 year. They are short term. Because any capital we employ must be a long term, because we want to, use them to finance long-term projects. We can't pull them out in the middle. So anytime you want to evaluate cost of capital, it has to be capital that is what? That is long-term. So equity is long-term, long-term liabilities is also a long-term capital. So these two are two core basics for capital we employ to fund our business. So that means we have equity and we have debt. So I call them two basic capital. So these two basic capitals, like I said, equity is just shares, ordinary shares. So we also have debt. But then this equity, if you want to calculate the cost we incur on equity, of course, what do we pay equity providers, which are referred to as shareholders? We pay them dividend, right? So the dividend we pay them is their return. But when we want to measure the dividend in percentage, we call it dividend yield, because dividend over market price per shares, right? But then whatever we call it, we call this guy cost of equity. The cost of equity is the return that we pay to shareholders in form of dividend. So cost of equity, right? So under debt, debt can be, we have one, first capital, two, second capital. Debt can be redeemable and it can also be irredeemable. Debt can be redeemable and it can also be irredeemable. So when we are talking about redeemable debts, but don't forget the cost for debt is called KD. That means the cost we pay to service our debt capital, which is in form of interest value. But when we want to turn it to percentage, we say interest over market price of the debt if the debt is redeemable. But don't let me mix it up. I have said we use equity and we use debt to finance our business. So having said that, I also said debt can be redeemable or irredeemable. What is redeemable debt, for instance? Well, redeemable debt can either be bond, which is straight bond, or debentures. We treat them the same way, debentures. Or the second one is convertible bond. Whether of these two, how do we calculate the cost? The cost is calculated as IRR. Anytime you have redeemable debt, we use IRR to calculate the cost of debt. And I will explain what I mean by IRR, plain bond, and convertible bond. Okay, let me start from what is the meaning of redeemable. If you buy shares with company, right? You buy shares with company. Sorry, you buy bond, for instance. Maybe you buy 5,000 bonds. 5,000 bonds. So these 5,000 bonds, maybe you are given bond certificate, and then the reason why they give share certificate, but they don't give share certificate again for some reasons, maybe when you are trading or so. So, but then let's use that as a case study here. So you're giving bond certificate of 5,000 units. It is not a physical substance. So when we say bond is just a debt instrument that is traded on stock market. What does company use it to do? Companies use bond to raise capital from investors in the market. Okay, so when we say it is redeemable, let's say this bond would last for 3 years or for 4 years, right? If it will last for 3 years or for 4 years, it means that in the first year I will collect interest, second year I will collect interest, third year I will collect interest. In the fourth year that the bond will mature, what I will collect is interest plus face value, and the face value here refers to, is referred to as nominal value. Just like shares have nominal value, bonds also have nominal value, which is we refer to as face value. Now, in the fourth year, by the time you collect the face value and interest, the company we also assume to have collected their bond back from you. So for them to collect back the bond, that is what we refer to as redeemable debt, because in the fourth year, the company will redeem it back. And after redemption, you do not collect any interest again. Why? The bond has been redeemed from you. Okay, so like as I was saying, the redeemable debt can be divided into two. We have straight bond and we have convertible. When we say straight bond, that is a bond that is straight, from that word straight, no conversion. When you buy the bond, let me call it vanilla bond, ordinary bond. You buy the bond from the bond seller, from a company that trades bond, and then all you enjoy is your interest. And after the year of maturity, you collect your face value, no string attached. But convertible bond is not straight. Why? Because at the end of maturity, you have the option to become a shareholder in that company. That means they will convert your bond to shares. And if you accept to convert, you will become a shareholder after you have enjoyed interest as a bond holder. And when we say irredeemable loan, irredeemable debt, that one is talking about loan, the one you obtain from bank. So number 3 is preference shares. Preference shares. Now we calculate cost of preference shares. Now the next subtopic is, after I have said we calculate cost of equity for equity capital, we calculate cost of debt for debt capital, and we also calculate cost of preference shares for preference shares capital. The next question you want to ask me is, how do we calculate? So that leads us to the next subtopic, how to compute the cost of capital. Now, the first one is how to compute the cost of equity. The cost of equity. The cost of equity can be computed in 2 ways. We can use capital asset pricing model, which is CAPM, and the formula is the same: risk-free plus beta, return on market minus risk-free. This is CAPM, using CAPM. This is one way. And number 2, we can use dividend valuation method. These are 2 ways of computing cost of equity. And the formula for dividend valuation method is dividend per share over, when there is growth, 1 plus G over market price per share X dividend, then plus G. I will label the formula, but let me pick it one by one. Where I have labeled CAPM for you before in this class, dividend per share, where G is growth, and where, what else? MPS, market price per share. Market price per share. Now, okay, let's now start. Under CAPM, don't forget, I started with explanation of what cost of capital is and the average cost of capital, because when we say cost of equity is cost of equity, debt is cost of debt, but we can also call cost of equity cost of capital. Why? For instance, if a company only has equity, they only have shares, they don't have debt, their cost of equity is also their cost of capital, and it is also their work. We are going to examine that when we get to a topic called capital structure. Capital structure. That is where we are going to be looking at some theories like Modigliani and Miller propositions. And I said, okay, don't forget, I broke it down here: equity, cost of equity; debt, cost of debt; preferences, cost of preferences. These are the major costs you will see in any question if you are to be tested on cost of capital. Now, how to compute cost of capital? I picked KE first, which is cost of equity. And then I said we can either use CAPM or dividend valuation method. If you're using CAPM, this is it. If you're using dividend valuation method, this is it. But now, we want to look at challenges, all right, or the challenge we can likely face. The challenge we can face using CAPM. All right, that is another subtopic. Now, I have given you CAPM formula, I've given you the valuation formula, but now I want to expand them further. Don't forget, we are still on cost of equity. We have not gone to cost of debt. Okay, now the challenge we can face using CAPM is beta determination. Now, the next thing, that's beta. Who can tell me what beta is? Beta is called systematic risk. Do you agree with me?
Yes, sir.
Somebody? Okay, thank you. Systematic risk. So, systematic risk here, what does it represent? Systematic risk is talking about the risk. Don't forget, I explained systematic and unsystematic under Kapim portfolio theory. And I said systematic risk is a risk that cannot be diversified through, that cannot be eliminated through diversification. Let me write it again. Systematic risk is a risk that cannot be eliminated eliminated with diversification. And another name for systematic risk is also called market risk. Market risk is also called unavoidable risk. Why unsystematic risk? Systematic risk, all right, is a risk that can be eliminated through diversification. Another name for it is called specific risk. Specific risk, or you call it avoidable risk. All right, but our concentration tonight is on beta, which is what? Systematic risk. Now, this beta is divided into two. This systematic risk can be divided into two, which is a business risk and finance risk. Now, some schools of thought can also use business risk and finance risk to explain unsystematic risk, but that is not our focus tonight, right? So we are focusing on systematic risk, and it's related with business and finance risk. So when we say business risk, that is a risk that is inherent in the nature of a business. Business risk is a risk that is inherent in the nature of a business. And then example of that: low in demand for a company's product, bad management. Don't let me say bad management. Let me just be specific now. Business risk has to do with what? Let's say the risk that is inherent in the nature of a business. Let me say, for instance, people know that transport business, for instance, has a risk of accident on the road. That risk is in nature of the business. We call it business risk. What about finance risk? That one has to do with the risk of raising debt and ability to meet up with servicing that debt. That means a company that does not have debt in its capital structure is not exposed to finance risk. I repeat, a company that does not have debt in its capital structure is not exposed to finance risk. So, if I may increase the volume, business risk is represented by beta of asset. All right, because everything we do with here has to do with symbols. We can represent it with symbols. Why business and finance risk can be represented with beta of equity. We have beta of assets, we have beta of equity, and we also have beta of debt. Beta of debt, which deals with debt factor alone, how shares responds to finance risk. Are we together, class? Are we together? But much emphasis is not laid on beta of debt. The major emphasis here are laid on beta of asset and beta of equity, because I said business risk and finance risk make up of beta of equity. Why beta of asset is only for what? Business risk. Now let me ask you a question. If a company is operating solely with equity capital, they do not borrow money from bank, which of these three betas are they going to be exposed to? They are only exposed to beta of assets. not beta of equity, because beta of equity comprises both business risk and finance risk. And I say finance risk has to do with debt capital. Once you have debt, you are exposed to finance risk. And that is why when we get to capital structure, we're going to see the relationship between gearing and cost of equity. That as a company increases their debt factor, they are exposing the shareholders to finance risk. And that is why they have to compensate them. And in the course of compensating them, it will be increasing the cost of equity upward. Are we together in this class? So if we do not have debt in our balance sheet, that the company is only funding itself using shares, they are only exposed to beta of assets. That means if you go to the internet and let's say Coca-Cola Yahoo Finance, Coca-Cola Yahoo Finance. So I've entered Coca-Cola Yahoo Finance. I want to go and check something about the company. So just follow me. Okay, thank you. So I click on statistics now, and I'm seeing beta 5-year monthly. The beta is 5-year monthly 0.44. I highlighted in blue color. So the beta for Coca-Cola company is 0.44, which means that now this beta, now I don't know if it is beta of equity or beta of assets. Well, how do I know? I'll go and check their balance sheet to know if this is a beta of asset or beta of equity. Interest income, not interest expense, fine. Now this interest expense means that even if I don't see their balance sheet, I've seen interest expense, which means that they are paying interest on their loan. And the most recent year, 2024, their interest expense has increased, which means they have increased their debt factor. That is why the factor, their finance cost, which is interest expense, has increased. Now, this interest expense means they have debt, right? And since they have debt, it means that their beta is beta of equity, not beta of assets. Now, which means that the beta of equity has debt factor in it. So, and beta of assets does not have debt factor, only equity alone. So now, where can we now face challenge with beta under capping during diversification? Now, anytime there is diversification, then there is need for us to separate beta of equity from beta of assets. How? Let me say, for instance, I am currently in water business. I produce water, and the water has business risk and finance risk. And I'm now looking into logistics, or maybe FMCG. And the company also, as maybe I'm looking at sugar production, which also has its business risk and finance risk, which is it has beta of assets and it has its combination of beta what? Equity. Now, the same beta of assets, combination as beta of equity. Now, class, I now begin to find companies that are already in logistic business. I want to capture their data, provided they are the same size of what I want to study. So I want to study that company as a proxy or as a surrogate. So I want to take their data, because why? Why do I need to take their data? Because if, for instance, I want to go into logistic business, I will do my modeling to check my future cash flows in that business, at least as estimate, as a forecast. That, okay, how much, of course, all of us here, if you want to do business, you will calculate in your head, how much will I be able to make in that business every month or every year or every day, whatever the business is. So in the same vein, I want to go into a new business, logistics. I will first of all do my future cash flows. That, okay, how much will I generate from the business in the next 4 years? If I estimate how much I would generate from the business in 4 years' time, what I need to do is to discount it to present value, just like what we do under NPV. When we get cash flows, we discount it with cost of capital. But guess what? Already for this water business I am doing, I have my work, my cost of capital I'm using to finance it. So if I now estimate what I will see in this logistic business, the cash flows I will see from this business for year 1, for year 2, for year 3, maybe I've estimated that maybe this year 1 I may see 10 million naira, in year 2 I may see 24 million naira, in year 3 I may see 50 million naira as cash flows. Now, it will be wrong for me to use this WACC to discount this cash flow from logistics, that is error. It is error. I cannot use this WACC to discount this cash flow from logistics. Do you know why? Because this WACC does not have this business risk in it. In other words, I need to find a WACC that will feature the business risk of the new investment. Once I find the beta, once I get the WACC, then it will now be suitable to use this WACC to discount the cash flows. It will not be suitable. For me to now feature this beta in my WACC, then it will lead me to what is called gearing and ungearing. What does this process say? It has to do with factoring the risk of new business into my existing WACC so that it will be suitable to evaluate the cash flow from that new business. So on that note, what I will do is 3 steps. Step 1, maybe when I get to this company, for instance, what I see, for instance, I want to use Coca-Cola as a case study. I want to use Coca-Cola as a case study. I get to Coca-Cola, I am seeing their beta to be 0.44. Of course, I know this beta is beta of equity. And what do I need, class? I need beta of assets. Now, mind you, why don't you need beta of equity? I do not need finance risk. I do not need finance risk. I only need business risk. I may borrow, but not the same borrowing that the company I am studying is exposed to. 1. And in my own capital structure, I may not even borrow. I may have some excess fund in retained earnings that I want to use to diversify into logistics. So I do not need the finance risk of the company I am studying, because don't forget, this beta of asset, I want to pick it from a company who is already in that business. So I do not need the company's finance risk. All I need is business risk. Okay, so how do I now, when I go to, for instance, Coca-Cola, all I see is their beta of equity, and I know this beta of equity has included in it beta of assets. How do I remove it from it? We call it ungearing. To extract beta of assets from beta of equity of the proxy. You will ungear the beta of equity using the proxy information. And how do I ungear? I will say beta of assets equals beta of equity times the value of equity over value of equity plus value of debt 1 minus t plus beta of debt times the value of debt 1 minus t divided by value of equity plus value of debt 1 minus t. This is how to ungear beta of asset from beta of equity. Now, with this one, I have taken beta of assets. Step 2. Regear. I want to regear it. The regear the beta of assets in step 1. In step 1 above, using your company information. How do I do that? I will say beta of equity now. I want to mix the beta of asset into my beta of equity equals beta of assets plus debt over equity into bracket beta of assets minus beta of debt into bracket 1 minus t, which is net of tax. And the last step three. Step three is compute, or let me say, use the beta of equity above to compute cost of equity. And how would that go? That is cost of equity is risk-free plus beta of equity into bracket to the market minus risk-free. Then we have completed calculating cost of equity using capping, which is this guy. Now, the next method, don't forget, I said it here, that to compute cost of equity, I can use capping or dividend valuation method. I can use capping. I've explained capping now. Now I want to go to dividend valuation method. So this dividend valuation method, you may hear using Gordon model, Gordon growth model, is still the same thing. So let me say number two, to compute cost of equity using Gordon model, Gordon growth model, it is dividend per share into bracket 1 plus G, all right, over okay, I should label this thing for you guys. Let me label the variables so that beta of equity means equity beta. It's still equity beta, not name way, no other name. VE means equity value. That means the value of equity. VD means debt value or value of debt. Then T means tax. All right. Beta of BD means debt beta. YBA means asset beta. Okay, let's increase the volume and go back to using dividend valuation method. Now we have market price per share X dividend. Now and then plus G. Now we have market price per share cum dividend and we have market price per share X dividend. What is the difference? When we say cum dividend, it means cumulative dividend, which means that the dividend of that year has not been paid, and so it is inclusive in the market price per share. And so for you to use that market price per share to compute cost of equity, you have to remove the dividend of that year from it. But if the question says that market price per share X dividend, it means that they have removed dividend from that MPS, so you don't need to remove it again. Just use it like that. All right, ladies and gentlemen, this cost of equity using Gordon model is not also free. Using Gordon model, they can also be challenged there. Okay, what kind of challenge? The challenge with Gordon model. So the challenge is basically on growth, is growth computation. Okay, now how do we compute growth? Growth can be computed as R times B, Gordon growth model, where R is return on shareholders fund. Oh my God, shareholders fund. You will love this topic, I'm telling you. Where shareholders fund, the formula is very simple, which is profit after tax over opening shareholders fund. Oh my God. Opening shareholders fund. Oh my God. You will love this. Now, class, can somebody tell me the difference between opening shareholders fund and closing shareholders fund? Let me know if you are still together. Can someone tell me the difference between opening shareholders fund and closing shareholders fund? And what do we even understand by shareholders fund? Let's know what we are doing here. Hello? Yeah. Hey, I will not fight. Can
Sir,
somebody
is
tell
this
me
shareholders fund at the beginning of the year?
what is it?
Shareholders fund at the beginning of the year. And shareholders fund is like total equity.
Total equity, right?
Yes, sir.
Total
Yes, sir.
equity. Okay, which means that what about opening and closing shareholders fund? What's the difference?
Closing shareholders fund is the one at the end. So of the year, maybe there was maybe they issued new shares or something. It to be different, or maybe the company bought back shares or something like that. It could cause the difference
Hey,
between closing shareholders fund.
daddy, you don't take us go where we don't know, but no problem, sha, it's fine. The simple difference between opening shareholders fund and closing shareholder fund, which is the most palpable one, is retained earnings. Because the difference between owner's equity of last year and this year is that we have added retained earnings most often, which is actually basic. Of course, there will be surplus of assets, there will be reserves, there will be share capital, there will be share premium, and so on. But majorly, when we have um opening shareholders fund and closing shareholder fund, the difference is just the retained earnings we had for that year. Okay, and for exam purpose, that is most likely what we'll be facing. So the R is return on shareholders fund. Why the B is called retention ratio. Retention ratio. So what's the formula for retention ratio? The retention ratio is simply retained earnings for the year. Okay, retained earnings for the year over profit after tax. So with this, we have completed the first growth calculation under Gordon model. Next one is using dividend valuation method. Don't forget, we are talking about calculation of growth under the second method. And then I pick Gordon, and I'm also going to pick what? Dividend growth model. Dividend growth model. So using dividend growth model is basically saying uh, earliest dividend over latest dividend, everything inside root of n minus 1. This is using dividend growth model. No stress, nothing, straightforward. Ladies and gentlemen, we have come to the end of computation of cost of equity. Can you clap palm for Jesus? So we are done with cost of equity. Now, the next one, which will not stress us at all, is cost of debt. And cost of debt, don't forget, I said it can be redeemable or irredeemable. And under redeemable, it can either be straight bond or convertible bond. But either it is convertible bond or it is straight bond, we use IRR to compute it. And why do we use IRR to compute it? IRR actually relates the outflow and inflow to be zero, right? Now, the simplicity of this IRR is that it captures all the interest we have been paying from day one and also the face value we pay at the end of the year. Let me explain how bond works again, so that by the time I go into explanation, it will look so very simple. Because in as much as we will not waste much time tonight, I want us to test a very simple question, and then that will show what we have grabbed. Okay, so the debt factor, don't forget, I said redeemable debt can either be straight bond or convertible bond. So the convertible bond and straight bond, I will treat them at once, neck and neck, tete a tete. So now, how to compute cost of debt? Here we are starting with redeemable, because the irredeemable has nothing at all. The little stress we need to understand is under the redeemable. And I said we use what? IRR to compute our what? Redeemable debt. Ladies and gentlemen, um, having said that, having said that, I will now use, okay, since I said we are using IRR, of course, if we are to use IRR, we can also use another formula, which is very simple, okay? But I will explain the two formula. IRR contains two processes or two steps. Step one, of course, is trial and error. Trial and error, which we work as if we are working with NPV. Trial and error. Okay, trial and error. And step two is interpolation. This one is sweet. Interpolation. Okay, whether we're dealing with straight bond or convertible bond. Okay, so if we are dealing with straight bond or convertible bond, we need three cash flows. Number one is market price per bond. Market price for bond, it is outflow in year zero. Under convertible, it is also the same way. Number two, we need interest, which is coupon rate, or let me call it interest rate, make it easy. Interest rate, all right, times nominal value. Interest rate times nominal value. The same thing, this will now be inflow from year one to the end. The same thing we'll do under convertible bond. So what is now the difference between straight bond and convertible bond? The difference occurs in the third cash flow, which is the face value. So the face value is talking about the amount you are going to be given in the year of maturity of your bond. Let me make it practical. If I buy a bond in, let's say in Dangote, maybe Dangote sells bond, just like they sell shares. So if it's the company sells bond and they say our bond is currently 120 naira per bond, it means that the bond is being traded, is being sold at a premium, because the tranche of that bond, that means the nominal value of that bond will be 100 naira. Let me say they say, okay, our current bond is, the bond price is 1,050 naira. It is sold at a premium because the nominal value of that bond is 1,000 naira. So bond is sold at a tranche of 10, 100, and 1,000, where Nigeria bond is traded at 1,000 tranche nominal value. So if, for instance, I buy Dangote bond at 100 naira per, let's say I buy the bond at 110 naira, 110 naira, 110 naira per bond. It means that at the end of the year, maybe at the end of the 4 years, they are going to return 100 naira to me. And why they return 100 naira to me is because every year I must have been collecting interest on the bond. So in the last year, they will give me my money back, face value, and the interest. They will redeem their bond back. So that is why under straight bond that is not convertible, the bond is inflow in year end. But for convertible value, since you can either become a shareholder with it, so what we are going to pick as the third item will be the higher of convertible value and face value. Which one is higher among the two? Now I go pick. Ladies and gentlemen, you may want to ask me, how do we calculate convertible value? Very simple and straightforward. Convertible value is P into bracket 1 plus G raised to power n times R, where P is market price per share, G is growth rate, N is number of years. I love this. Where R is number of shares. This one says that instead of you guys giving me my 100 naira nominal value, let me know how much I will receive if I'm converting to become a shareholder. They will convert it and give me the price that, Oga, if you want to convert, you will get this one. Then I will compare this convertible value with my face value. If convertible value is greater than face value, I will convert. If it is not greater, I will not convert. Ladies and gentlemen, I believe you are loving this class. We are done with cost of redeemable shares. redeemable debt rather. We are done with the cost of redeemable debt with this short thing on the screen. Now, don't forget, I will take you back through the memory lane. We are dealing with WACC. I have taught us how to compute cost of equity. I also taught us how to compute cost of debt, which is redeemable. Now, we want to look at cost of loan. That one is straightforward. The cost of loan is interest into bracket 1 minus t. 1 minus t, where t is tax. Nothing more. No stress. For preference shares, it's also very straightforward. It is dividend per share over market price, all right, per share, x dividend for preference shares, nothing more.